Well, there's been a lot of talk lately about silver possibly exploding into a whole new price world this year and never really settling back into the old one. So in this video, we're going to separate what is solid from what is hype, and you are going to walk away feeling a lot smarter and a lot calmer about what may actually be happening in this market. And by the way, today is Tuesday, April 14th in New York, so let me know in the comments what day and date you're watching from. And if you value my work, subscribe and comment our John AG. That simple action helps more than most people realize. So in case you've been hearing some of the louder claims going around, the basic idea is this. Silver has already broken out. Silver miners are starting to run harder than gold miners. The money system keeps getting weaker over time. And once silver gets out of this current stop-and-go zone, the next move could be a lot more violent than the last one. On the surface, that sounds wild, but not all of it is wild. A lot of it is actually rooted in real price action. Based on recently published numbers, silver has been trading around the mid to upper 70s. Gold has been holding in the upper 4,000s, and miners have been acting much better than they were just a few years ago. So yes, there is a real bull market here. This is not a made-up story. This is not wishful thinking. The market has already done enough to force people to pay attention. But here's where I want to slow everybody down for just a second. A real bull market and an instant straight-line launch into some gigantic price target are not the same thing. Those are two different claims. And if you blur them together, you stop thinking clearly. That's where people get trapped. That's where people chase, and that's where good ideas get ruined by bad timing. So let me show you what I mean. The broad bullish case for silver is pretty straightforward. First, silver has finally started acting like the faster metal again. For a long time, gold carried the whole complex, while silver kept teasing people, disappointing people, and then rolling back over. But once that relationship changes, it can change hard. The laggard stops being the laggard. It starts behaving like it has something to prove. And that matters because silver does not usually move like a calm, polite market. Silver tends to move like a crowded door finally getting kicked open. It waits, it stalls, it frustrates, and then when it goes, it does not ask for permission. That's why people who are late to silver almost always think the move is over right before the next real push begins. We already saw a taste of that earlier in the run. Silver ripped higher in a very short period, and it did what silver usually does after a fast surge. It punished emotional entries. People who bought because the chart looked exciting got hit. People who bought because everyone around them got bullish got hit. And then, because headlines out of the Middle East were flying everywhere and oil started whipping around, the correction got messier and louder than it probably needed to be. Now, does that mean the whole move was fake? No, not even close. Fast markets pull back, especially silver, especially after a big run. What matters is not that a pullback happened. What matters is where the market pulled back to, how it behaved there, and whether buyers kept showing up once the panic cooled off. That part, in my opinion, is much more important than the scary headline people chose on the worst day of the drop. And from recent market updates, one thing is clear. Buyers did come back. Not in a perfect straight line, not in some fantasy way, but they came back. Silver stabilized, then lifted again, and the market started leaning right back into the same idea that was driving it before the correction. That tells you the underlying appetite is still there. It tells you the market has unfinished business. Now let's talk about the extreme target everybody loves repeating because this is where emotion can outrun evidence. The claim that silver goes into the 300 to 500 zone this year, maybe even by summer, is not something current mainstream forecasts confirm. Not even close. Recently published surveys from major bullion watchers and a broad poll of analysts center much lower, around the upper 70s on average, with some bullish highs reaching into the low 100s, or, in a few cases, the mid 100s. That does not kill the bull case. It just tells you that the most aggressive target is still an outlier, not a consensus fact. And honestly, that's an important distinction because you do not need silver to hit the most dramatic number in order for silver to remain the better performing metal. Those are different conversations. Silver can massively outperform gold without touching the most sensational target on the internet. In fact, if you anchor yourself too tightly to one giant number, you can miss the whole move while waiting for a perfect script that the market never promised you. This is why I think the cleaner way to see the setup is not silver must hit this exact number by this exact date or the thesis is dead. No, the cleaner way is this. Has silver entered a new regime where it can keep outrunning gold for stretches of time, where the miners can catch another leg, and where higher price zones that once looked ridiculous now have to be taken seriously? I think the answer to that is yes. I really do. But even there, I want to add some discipline. Because one of the biggest mistakes in these markets is taking a strong thesis and then turning it into an absolute. For example, Saying war has nothing to do with gold or silver is too clean. Reality is messier than that. Geopolitical stress can absolutely push money toward gold in particular. We've seen that before. We've also seen moments when gold gets sold during stress because traders need liquidity right now. Both things can happen. So, the honest answer is not never and not always. It depends on the kind of stress and the timing. That matters because some people want one single driver for this whole move. They want one neat explanation. But markets do not usually give you that. Gold can be reacting to currency concerns, central bank demand, falling real confidence in policy, geopolitical fear, and simple momentum all at once. Silver can be riding alongside that while also carrying its own industrial story and its own higher volatility personality. That combination is exactly why silver can look sleepy for months and then suddenly look unhinged. And silver does have a real-world demand side that people sometimes forget when they treat it like a casino chip. Based on the latest mineral data, silver is still deeply tied to electronics, solar applications, bars, and coins, and a wide list of industrial uses. So, this is not just a metal with a narrative, it is a metal with multiple demand channels. That does not guarantee runaway prices, of course, but it does matter when investor demand starts piling on top of industrial demand instead of replacing it. There is another piece here that I think deserves more attention too. Silver was recently added to the final list of critical minerals in the United States. Now, that does not mean the government rings a bell and silver jumps overnight. That's not how markets work. But it does tell you silver is being viewed through a more strategic lens now, not just a jewelry and coins lens. It matters for manufacturing, electronics, energy infrastructure, and supply resilience. That is a different conversation than the one most retail traders are having. So when I hear somebody say silver is only moving because of fear, I don't buy that. And when I hear somebody say silver is only moving because of industry, I don't buy that either. It's both. It's monetary and industrial. It's investment demand and real-world use. It's the metal that can behave like a precious metal and like a strategic material at the same time. That blend is part of what makes silver so dangerous to bet against once momentum really wakes up. Now let's move to miners because this is where the upside gets even more interesting, but also where the risk gets misunderstood. The case for silver miners and gold miners outperforming the metal itself is not crazy at all. We've already seen strong money flow back into precious metals funds, and miner funds have attracted serious attention during this run. One of the major miner funds is sitting around the upper 90s, which tells you this is not some dead corner of the market anymore. People are back in the space, but miners are not magic. They are businesses. They have management risk, cost risk, political risk, energy risk, and country risk. So when people say just buy miners because they're leveraged metal, that's only half the truth. The other half is that miners can absolutely magnify the move, yes, but they can also magnify the pain when the tape turns ugly. That is why the best miner runs usually happen when the metal trend is real enough to overpower all those other headaches. And recently, there have been signs of that kind of appetite. Big inflows into gold and precious metals exchange-traded funds earlier this year, with miner funds seeing their strongest monthly intake in many years, tell you capital has already started testing the higher beta side of the story. That doesn't mean every miner wins. It does mean this corner of the market is no longer being ignored. And when neglected sectors stop being ignored, repricing can happen faster than people expect. So, if the metals keep climbing, I understand why somebody would rather lean into silver and miners for offense while using gold more like the balance wheel. That framework actually makes sense to me. Silver for torque, miners for leverage, gold for durability. Those roles are different, and when you confuse them, you usually wind up frustrated. That brings me to the profit question because this part actually matters more than most people realize. Let's say silver does make another huge run. Let's say the miners really start acting crazy. Then what? Do you sell into cash and sit there? Do you rotate into gold? Do you hold everything? This is where the competitor version of the story gets too absolute for me. I understand the argument against parking everything in bank cash for long periods. Cash loses purchasing power over time. That is true. Official inflation data over the past decade make that painfully obvious. But saying cash is useless in all cases goes too far. Cash is dry powder. Cash is flexibility. Cash is what lets you buy a violent dip when everyone else is panicking. So, I'm not anti-cash in every circumstance. I'm anti-staying asleep in cash for years while pretending nothing is being diluted. What I do think makes sense is understanding the difference between a trading asset and a reserve asset. Silver can be the fast horse. Gold can be the vault. That doesn't mean gold is boring. Gold has been anything but boring lately. But gold usually behaves more like the place you store conviction, while silver behaves more like the place you express aggression. And the gold backdrop remains very strong. Recently published pricing showed gold still holding in the upper 4,000 range. And broader demand research says central banks stayed heavy buyers last year, while investment demand remains strong. On top of that, official market research going into this year still expects continued support from geopolitical tension, policy uncertainty, and the possibility of easier rates later on. In other words, gold does not need silver's fireworks to justify its role. It already has its own foundation. Now, here's where the macro discussion gets really important, because a lot of people are taking a handful of real numbers and then making a leap that is much bigger than the numbers themselves. Yes, the Federal Reserve kept rates unchanged at the last meeting. Yes, officials still described inflation as somewhat elevated. Yes, they also acknowledged uncertainty around the economy and developments in the Middle East. All true. But that is not the same thing as a guaranteed emergency pivot tomorrow. The labor data are mixed, not collapsing. Payrolls grew by roughly 180,000 in March. Unemployment sat around the low fours, and wages were still rising at a decent clip over the year. At the same time, job growth has clearly cooled from hotter periods. Financial sector employment has weakened from last year's peak, and federal payrolls have been sliding. So yes, there are soft spots, but this is not a clean recession signal yet. It's a mixed picture. And mixed pictures can keep markets choppy longer than bulls or bears want to admit. Inflation is mixed too. Consumer inflation moved back up into the low threes year over year, while the Fed's preferred inflation gauge was still sitting in the high twos with core running a bit hotter. So, when people say inflation is dead and cuts are obvious, that is too simple. And when people say inflation is back out of control and metals are doomed because rates stay high forever, that is too simple too. The real story is that inflation has cooled from the worst levels, but it is still sticky enough to keep policymakers uncomfortable. Now, could the Fed still end up cutting later? Absolutely. Could weaker growth, market stress, or some financial accident give them cover? Of course. But I don't think you need to invent a guaranteed near-term cut in order to justify being bullish on metals. Gold and silver can do very well in a world where policy stays tight for a bit longer than expected, especially if investors stop trusting the long-term purchasing power of paper money. There's also a timing point people keep bringing up around the Fed chair. Yes, his current term as chair is set to end in the middle of May. And yes, markets always try to read politics into that kind of calendar. But I think investors should be careful not to turn that into a fairy tale. The Fed just held its target range in the mid-threes, and market pricing for cuts later this year has been moving around with every inflation print, every oil swing, and every headline out of the Middle East. That is not the same thing as a locked-in rescue. It means traders are uncertain, and uncertainty itself can keep precious metals attractive even before an actual cut arrives. Meanwhile, silver proxies and miner funds are already telling you interest is real. One big silver fund has been sitting in the upper 60s, while the major miner fund has been hovering around the upper 90s. That's not sleepy money, that's attention. And attention, once it starts building in this space, has a habit of feeding on itself very quickly. And that brings us to the money supply argument, which again is directionally right, but often exaggerated in a way that hurts credibility. Broad money is still sitting around $22.5 trillion. That is enormous. The system carries much more money than it did before the great inflation scare of recent years. So, the long-run debasement conversation is real. But you do not need cartoonish claims about cash losing almost everything overnight to make that point. The honest point is strong enough already. When the supply of money grows far faster over time, hard assets matter more. That's really the deeper thesis here. Not that every crisis instantly sends silver vertical. Not that every war headline means buy now or miss everything. Not that every correction is manipulation. No. The deeper thesis is that confidence in money, policy, and financial assets gets tested in waves, and precious metals benefit when those tests get louder. Gold has already been showing you that. Silver is now trying to tell the same story, but in a much more aggressive accent. And because silver has spent so many years living in gold's shadow, it does not take a complete change in the world for silver to shock people. It only takes a change in perception. Once enough capital decides silver is no longer the sleepy sidecar and is now the catching up trade, the move can become self-feeding for a while. That is why I keep coming back to the silver versus gold relationship. Silver is still only a very small fraction of gold's price right now. In plain English, even after this big run, silver has not fully caught up on a historical relative basis. It is improved, yes, but it still has room if this really turns into a later stage mania. That does not prove a trip to the most extreme targets. It does show why silver bulls still feel they have open air. And psychologically, this market still does not feel like a finished top to me. Why? Because disbelief is still everywhere. People still laugh at the bigger silver targets. People still think every drop means the whole idea is over. People still treat gold as if it's only a fear trade, and silver as if it only works for 1 week at a time. That is not what full public euphoria sounds like. Full euphoria sounds very different. We are not there. Let me ask you something. Do you think silver is just in a hot streak? Or do you think we're watching the early stages of a real monetary repricing? Put that in the comments. Because how you answer that question changes everything about how you interpret this chart. And here's another one. If you had to choose right now, would you rather own physical silver, physical gold, or the miners? I'm always curious where people stand when the market gets this emotional, because your answer usually tells me whether you're thinking offense, defense, or speculation. Now, one thing I do agree with from the original bullish outline is that if silver breaks cleanly out of a noisy zone like this, the next leg can feel bigger than the last one. That part makes sense. Breakouts after messy consolidations often do that, especially in assets with the history of explosive follow-through. But the market still has to do the work. It still has to prove it. You don't get paid because the story sounds exciting. You get paid because price confirms. And there are a few things I would watch for if you're trying to judge whether that bigger move is really beginning. I'd watch whether silver can hold higher lows after bad news. I'd watch whether gold remains firm even when the dollar bounces. I'd watch whether miner funds keep attracting capital on dips instead of only on up days. And I'd watch whether the market starts absorbing scary headlines without falling apart. That's what strength looks like. I'd also watch the public because the public is always late, but it matters when they show up. When an asset moves from being ignored, to mocked, to debated, to chased, you are watching a ladder of attention. Silver has clearly moved past ignored. It may even be moving past mocked. But chased? I'm not sure we're fully there yet. And that's one reason the upside discussion still matters. At the same time, I want to challenge one more lazy idea that shows up in these hyperbull scripts. The idea that once silver enters some huge new range, it can never have serious pullbacks again. That's not how silver behaves. Even in the best case, silver is still silver. It can rally like a beast and then drop hard enough to make disciplined people question everything. So even if this market is heading much higher over time, that does not mean the path becomes gentle. In fact, the more explosive the eventual move, the more likely you are to see brutal shakeouts inside it. That's not bearish. That's just the personality of the metal. A lot of newer traders are going to learn that the hard way. They think volatility ends after the breakout. No. In many cases, volatility becomes the breakout. So when somebody says silver could move into a wildly higher long-term zone and still suffer savage pullbacks inside that zone, that part is believable to me. That is actually one of the more realistic parts of the whole big bull framework. New regimes are messy. Repricing is messy. Discovery is messy. There is no law that says a higher plateau has to feel comfortable while it is being built. And yes, there is a scenario where silver overshoots. Markets do that all the time. When an asset is mispriced for years and then suddenly gets attention, it rarely stops exactly at fair value. It usually swings through it. It goes too far. It gets noisy. Then it snaps back. That is not unique to silver. That is just what happens when human emotion joins a real macro shift. But again, and this is important, acknowledging the possibility of an overshoot is not the same thing as confirming the biggest target on the table. I think that distinction matters if you want to be bullish and still keep your brain switched on. You can believe silver has entered a fundamentally different phase without pretending every dramatic timeline is already locked in stone. From recent market commentary and fresh official data, the better supported version of the thesis looks something like this. Gold remains structurally strong. Silver has much more torque and still has room to outperform on a relative basis. Miners are finally getting real attention again. The money backdrop remains supportive over the long run. Policy may ease later, but it is not a guaranteed immediate pivot. Geopolitical tension can help, hurt, or simply add noise depending on the moment. And because of all that, the precious metals complex still looks alive, very alive. That is a strong thesis. You do not need to decorate it with nonsense. You do not need to invent a magical straight line. You do not need to tell people cash dies instantly, wars never matter, or one meeting at the Fed changes everything overnight. The truth is already interesting enough. And from an investing point of view, the practical takeaway is pretty simple. If you want the steadier core, gold still makes sense. If you want more upside and more drama, silver still makes sense. If you want leverage to the theme and you can handle bigger swings, miners still make sense. What doesn't make sense is pretending those are all the same instrument. They're not. They each do a different job. That's also why I think the strongest positioning idea in the raw outline was not the exact price target. It was the asset hierarchy. Silver and miners for outperformance. Gold for storage of gains. That framework actually has logic behind it. You may adjust the weightings. You may keep some cash. You may stagger entries. Fine. But the basic architecture is not crazy. And I'll add one more fresh piece that people are underestimating. Gold research this year has been openly talking about stretched valuations in other assets, persistent macro risk, stronger inflation hedging demand, higher stock-bond correlation, and the possibility that quality assets gain a bigger role in portfolios. That matters because it tells you metals are not only benefiting from doom, they're also benefiting from a portfolio shift. When traditional diversification feels less reliable, gold starts looking less optional. And once gold looks less optional, silver often gets dragged into the spotlight later. So no, I do not think the move is finished just because silver had a hard correction. No, I do not think miners are too late just because they've already bounced. And no, I do not think you have to believe the wildest number on the internet in order to be constructively bullish here. What I do think is that this market has crossed an important psychological line. The conversation is no longer whether gold matters. It clearly does. The conversation is no longer whether silver can move fast. It already has. The real conversation now is whether silver's recent behavior is just a hot episode or the opening stage of a broader re-rating that could last much longer than most people are prepared for. My view? We are much closer to the second one than the first. I think silver is in a market that can still shock people on the upside. I think gold remains the calmer backbone underneath it. I think miners can keep surprising if metal prices stay elevated and capital keeps flowing in. And I think the biggest mistake right now is not skepticism. Skepticism is healthy. The biggest mistake is shallow thinking, because shallow thinking says, silver didn't hit the craziest target immediately, therefore the thesis is false. Shallow thinking says, gold dipped on a war headline once, therefore geopolitics never matter. Shallow thinking says, the Fed held once, therefore easing is impossible. None of that is serious analysis. Serious analysis weighs what is real, what is probable, and what is merely possible. And what is real right now is a precious metals market that has already forced a major revaluation from investors, analysts, and policy watchers. What is probable is more volatility, more headline-driven swings, and more debate around the path of rates and growth. What is merely possible, but not confirmed, is the most explosive version of the silver target. That's the bucket I put the 300 to 500 talk in today. Possible in a mania, not confirmed on schedule. That does not make me bearish. If anything, it makes me more confident because I'm not hanging the whole bull thesis on one dramatic promise. I'm hanging it on multiple pillars that are already visible. Strong gold, resilient silver, improving miner interest, sticky macro uncertainty, still large money supply, and a market that keeps reloading after violent moves. That is a sturdier foundation than a single viral headline. And listen, this part matters too. If you're successful, share your success story in the comments so others can stay motivated. Markets are hard. People need to hear from someone who stayed disciplined, stayed patient, and came out the other side stronger. So how likely is it that silver has already changed character in a way that can carry it much higher over time? In my opinion, very likely. How likely is it that gold keeps acting as the reserve metal underneath this whole move? Also very likely. How likely is it that miners continue getting dragged higher if bullion stays firm? Pretty likely. How likely is it that the most extreme silver target arrives exactly on the loudest timeline people are pushing right now? That, I think, is a much tougher call. But you know what? Even that tougher call is not the main point. The main point is that people are still thinking too small about the regime change and too simplistically about the path. One side underestimates how powerful a silver catch-up phase can be. The other side underestimates how messy a real bull market can feel. The truth is probably sitting right between those two mistakes. So, if you want my bottom line, here it is. I still lean towards silver and the miners as the higher upside side of the complex. I still view gold as the metal I would trust most to hold value through policy confusion, currency erosion, and market stress. I still think the current zone in silver looks more like a pressure chamber than a tombstone. And I still think the people waiting for a completely comfortable entry are probably going to keep finding excuses while the market keeps inching away from them. That does not mean chase green candles blindly. It does not mean ignore risk. It does not mean turn every pullback into a conspiracy theory. It means know what you own, know why you own it, and understand which part of the metal story each asset is supposed to play in your portfolio. If silver really is heading into a much larger repricing, you won't need to force the story. The chart will keep proving it. Gold will keep confirming the backdrop. The miners will keep waking up. And every time the market tries to scare people out, it will recover in a way that tells you the bid is deeper than the headlines. That is what I'm watching now. Not fantasies, not slogans, not one magic number. I'm watching for confirmation that the market has moved from a powerful rally into a durable new phase. And right now, I think there is enough evidence on the table to take that possibility very seriously. Subscribe if you want this kind of sharp, grounded breakdown without the fluff, because in markets like this, clarity is worth a lot. And as always, this is for education and discussion only, not personal financial advice. You still need to do your own homework, think about your own risk, and make decisions that fit your own money and your own life.